Hi everyone, welcome to Be Different for Success. Today we'll be talking about Bitcoin. What is Bitcoin? Bitcoin is a digital currency created in January 2009, following the housing market crash. It follows the ideas set out in a white paper by the mysterious and pseudonymous Satoshi Nakamoto. The identity of the person or persons who created the technology is still a mystery. Bitcoin offers the promise of lower transaction fees than traditional online payment mechanisms and is operated by a decentralized authority, unlike government-issued currencies. There are no physical Bitcoins, only balances kept on a public ledger that everyone has transparent access to. That, along with all Bitcoin transactions, is verified by a massive amount of computing power. Bitcoins are not issued or backed by any banks or governments, nor are individual Bitcoins valuable as a commodity. Despite it not being legal tender, Bitcoin charts high on popularity and has triggered the launch of hundreds of other virtual currencies collectively referred to as altcoins. Understanding Bitcoin. Bitcoin is a collection of computers or nodes that all run Bitcoin's code and store its blockchain. A blockchain is simply a collection of blocks, and in each block is a collection of transactions. Because all these computers running the blockchain have the same list of blocks and transactions, and can see these new blocks being filled with new Bitcoin transactions, no one can cheat the system. Anyone, whether they run a Bitcoin node or not, can see these transactions occurring live. In order to achieve a nefarious act, a bad actor would need to operate 51% of the computing power that makes up Bitcoin. As of May of 2020, Bitcoin has around 47,000 nodes, and this number is growing, making such an attack quite unlikely. In the event that an attack was to happen, the Bitcoin nodes or the people who take part in the Bitcoin network would likely fork to a new blockchain, making the effort to achieve the attack a waste. Bitcoin is a type of cryptocurrency. Balances of Bitcoin tokens are kept using public and private keys, which are long strings of numbers and letters linked through the mathematical encryption algorithm used to create them. The public key, comparable to a bank account number, serves as the address which is published to the world and to which others may send bitcoins. The private key, comparable to an ATM PIN, is meant to be a guarded secret and only used to authorize Bitcoin transmissions. Bitcoin keys should not be confused with a Bitcoin wallet, which is a physical or digital device which facilitates the trading of Bitcoin and allows users to track ownership of coins. How Bitcoin works. Bitcoin is one of the first digital currencies to use peer-to-peer technology to facilitate instant payments. The individuals and companies who own the governing computing power and participate in the Bitcoin network are comprised of nodes or miners. Miners, or the people who process the transactions on the blockchain, are motivated by rewards, the release of new Bitcoin, and transaction fees paid in Bitcoin. These miners can be thought of as the decentralized authority enforcing the credibility of the Bitcoin network. New Bitcoin is being released to the miners at a fixed but periodically declining rate, such that the total supply of Bitcoins approaches 21 million. As of July 2020, there are roughly 3 million Bitcoins which have yet to be mined. Bitcoin mining is the process by which Bitcoins are released into circulation. Generally, mining requires the solving of computationally difficult puzzles in order to discover a new block, which is added to the blockchain. In contributing to the blockchain, mining adds and verifies transaction records across the network. For adding blocks to the blockchain, miners receive a reward in the form of a few Bitcoins. The reward is halved every 210,000 blocks. The block reward was 50 new Bitcoins in 2009 and is currently 12.5. On May 11, 2020, the third halving occurred, bringing the reward for each block discovery down to 6.25 Bitcoins. A variety of hardware can be used to mine Bitcoin, but some yield higher rewards than others. 1 Bitcoin is divisible to 8 decimal places, 100 millionths of 1 Bitcoin, and the smallest unit is referred to as a Satoshi. Security risks of Bitcoins. Most individuals who own and use Bitcoin have not acquired their tokens through mining operations. Rather, they buy and sell Bitcoin and other digital currencies on any of a number of popular online markets known as Bitcoin exchanges. Bitcoin exchanges are entirely digital, and as with any virtual system, are at risk from hackers, malware, and operational glitches. If a thief gains access to a Bitcoin owner's computer hard drive and steals his private encryption key, he could transfer the stolen Bitcoins to another account. Users can prevent this only if Bitcoins are stored on a computer which is not connected to the internet, or else by choosing to use a paper wallet, printing out the Bitcoin private keys and addresses, and not keeping them on a computer at all. Investing in Bitcoins. Though Bitcoin was not designed as a normal equity investment, some speculative investors were drawn to the digital money after it appreciated rapidly in May of 2011 and again in November of 2013. Thus, many people purchase Bitcoin for its investment value rather than as a medium of exchange. However, their lack of guaranteed value and digital nature means the purchase and use of Bitcoins carries several inherent risks. Like with any investment, Bitcoin values can fluctuate. Indeed, the value of the currency has seen wild swings in price over its short existence. Subject to high volume buying and selling on exchanges, it has a high sensitivity to news. According to the CFPB, the price of Bitcoins fell by 61% in a single day in 2013, while the one-day price drop recorded in 2014 was as big as 80%. Investing money into Bitcoin in any of its many guises is not for the risk-averse. Bitcoins are a rival to government currency and may be used for black market transactions, money laundering, illegal activities, or tax evasion. As a result, governments may seek to regulate, restrict, or ban the use and sale of Bitcoins, and some already have. Others are coming up with various rules. The lack of uniform regulations about Bitcoins raises questions over their longevity, liquidity, and universality. The concept of a virtual currency is still novel, and compared to traditional investments, Bitcoin doesn't have much of a long-term track record or history of credibility to back it. With their increasing popularity, Bitcoins are becoming less experimental every day. Still, after 10 years, they remain in a development phase and are consistently evolving. There are many Bitcoin supporters who believe that digital currency is the future. Many of those who endorse Bitcoin believe that it facilitates a much faster, low-fee payment system for transactions across the globe. Although it is not backed by any government or central bank, Bitcoin can be exchanged for traditional currencies. In fact, its exchange rate against the dollar attracts potential investors and traders interested in currency plays. Indeed, one of the primary reasons for the growth of digital currencies like Bitcoin is that they can act as an alternative to national fiat money and traditional commodities like gold. Thanks for watching this video. I hope you liked it. Please click the thumbs up and write your personal tips in the comments below. Thank you for your support, and don't forget to subscribe to the channel if you want to hear more from us. See you in the next video.